Without further delay, I'd like to introduce moderator Alex Zuluaga. Alex is a partner and SPAC co-leader with Ernst & Young and has extensive knowledge of SPAC mergers, including accounting, reporting, regulatory, operational, and integration. He's assisted with dozens of SPAC transactions in the past 8 years. Thank you, Alex, for contributing to and moderating our panel today, and I turn it over to you.
Thank you, Leanne. Let me introduce our two other guests. Travis Wilford's the Vice Global Chair of M&A Practice at Baker Botts. He's worked in various situations. He has a significant experience in financing transactions and SPACs. And Paul Hobby is a managing director at Genesis Park. He has held CEO roles. He's worked on boards and is very active in the SPAC space as well. Thank you, Paul and Travis, for joining us. So just to get started, just to level set, we're going to go through a little bit of SPAC 101 just to make sure everybody's on the same page. We'll walk through SPAC formation, thinking about acquisition targets, and then ultimately think about the SPAC process in the de-SPAC phase, where the entities really become a public entity that is acquired. So SPAC 101. So I'm sure that everybody on this call has had plenty of experience listening to webcasts, having conversations with your management teams, et cetera. But just quite briefly, a SPAC is a public entity that raises capital in order to acquire another entity. Its life is typically 18 to 24 months. And there are certain protectionist measures that are developed within a SPAC in order to provide for the investors to receive their money back, which is in the form of redemptions that take place, close to the closing of the transaction. The structures that SPACs typically have is that they will acquire another entity, typically a private entity. Many times it is a minority position that is acquired, but there are instances in which a majority position is actually acquired by the SPAC. Without further ado, maybe get into what people are really interested in, which is kind of the nuts and bolts and think about what directors have to think about when they're thinking about SPAC. So, with that, Paul, when we're thinking about SPAC formation, there's a lot of considerations there in terms of, what is something that you end up having to think about as a sponsor, as a board member. When you were first kind of thinking about, being involved in SPACs, what was kind of your thought process, and ultimately how do you think about selecting board members yourself for the SPACs that you've been involved with? If we could just have the host take Paul off mute.
There you go. No, I got it. That's the right question. I think the first question is, do I have a strategy? And there are plenty of generalist SPACs out there who say, gosh, these are private equity economics. We're smart guys. We have a lot of track record. Fill up this public trust account and we'll figure out something groovy to do with it. That was the origin of the SPAC vehicle was much less investor friendly than it is today when a guy named Nussbaum did the first one in 1983. That generalist approach doesn't work well for me, because if you think about what you have to do here, to distinguish yourself, you want to source in a differentiated way, you want to add value to the target, and then you want to execute after the fact. We're a value-added private equity shop. I hope we're a value-added public equity shop. And so to have a bunch of money changers on your board, just a bunch of Wall Street types that, maybe they hear about something on the golf course, I don't think that's as good as sort of saying, let's pick a strategy, let's pick a board that's appropriate to that strategy to source and to execute and to add value after the fact. So we did a contrarian aviation aerospace SPAC, during the depths of COVID, and where we ended up transacting was a little differently than where we thought we would end up. We executed in the aerospace infrastructure part of the equation as opposed to traditional terrestrial aviation. We can talk more about this, but the recovery played out as we thought it would. The dearth of capital never materialized. A lot of these airlines, as you saw, never even took government money, and they just never had the liquidity squeeze that we expected. But I think that's the first thing, is a first-class board that's not just your friends, people of integrity, but people that can source a differentiated, non-marketed deal. People can execute that deal and then add value after the fact. So those are my thoughts.
That's fantastic, Paul. Travis, anything else to add there in terms of kind of your interactions with board members and the different roles that they play in kind of interacting with your practice?
Yeah, so I mean, I think Paul kind of hit the nail on the head in terms of figuring out who the sponsor is that you're getting in bed with. I mean, people have the opportunity to do a SPAC poll. I highly recommend you take that. But you need somebody that's got reputation. He mentioned the proprietary deal flow as opposed to just a bunch of wannabes. I think they also need to have the ability to raise capital through a pipe, given just how the market is and how the redemption rights work. And then you need to figure out who the actual officers of the SPAC are going to be, who are doing the diligence, who are dealing with the governance, compliance, accounting, disclosure, the legal, and the like. Do they actually know what they're doing? Because in the IPO and then in the process between the IPO and the de-SPAC, they're not doing things properly, and a lot of them are. You're going to be taking liability on that as a director. We can get into the kind of the pre-IPO things that people should be looking at to mitigate that liability. I think that's important. And another thing that Paul mentioned when we were talking about this before is, directors need to ask themselves why they're going to be joining the board of the SPAC. What are they getting out of it? Because there are risks.
Yeah. And Travis, it sounds like maybe some people are having a little difficulty hearing you. And so if you could just boost your mic volume or maybe get a little closer to the mic. But I think one of the things, just leading off of what you just said, which is, thinking about it as an individual, why join a SPAC board? Kind of what considerations are there? I mean, Paul, maybe if you could just go into that a bit and kind of talk about your experiences, what you've seen that's been kind of worked well for you, and maybe what you've seen with other board members that, quite frankly, maybe shouldn't be board members if you're thinking about going into or being approached by a SPAC.
I think it's the same thought process as any board, and that is, am I interested? Are these people I admire? Am I going to learn something? Am I going to add value? In a SPAC environment, make no mistake, Travis alluded to this, this is a public company environment. There are regulators and plaintiffs' lawyers who are circling and dying to play gotcha on any number of fronts. So if risk mitigation, if your first question is, let me read the D&O policy, you probably shouldn't do this. It is a live fire exercise in public markets. And unless you're company in public markets, you're the people that are around you and they have relevant experience, you probably shouldn't do it. But it does come back to, are you interested? Are these people you admire? Are you going to learn something? Are you going to add value?
Yeah, and maybe, what have you gotten out of, being part of these boards? I mean, what personal benefit have you been able to acquire having had this experience? Well,
I could brag on my board, but it is really kind of the dean's list of public aviation executives. And a lot of these people have been friends of mine for 20 years. And so to have finally found this thing that we're going to do together has been great fun. And I've learned so much and admire these people a lot. But, I'm the CEO, I'm the sponsor of the SPAC, so I'm ultimately responsible, and I'm comfortable with that. I've been doing this thing for a long time. But does the responsibility weigh heavily? of bringing friends into this sort of thing and making sure it executes cleanly and tightly? Yeah, of course it does. I've been doing public things a long time, in public service, you get sued all the time. So I'm more used to it than most people. Not that our SPAC has been sued, or we're not going to be either, but I'm just saying it doesn't break me out in hives the way it does most people, just because I'm a lawyer and I've been in public life, and that's what happens.
Thanks, Paul. And Travis, maybe can you talk a little bit about how you interact with board members and thinking about some of their fiduciary duties? How do you coach up board members as they ask you questions?
Yeah, so it depends on who I'm representing, right? So right now I'm representing a group of directors that are going to be co-investors and with a sponsor. And so when we're doing that, we're going through things, the basic obvious blocking and tackling of making sure that there's D&O insurance, making sure that the sponsor themselves are on the hook for the indemnity, because, just keep in mind, the SPAC, once that money comes in from the IPO, most, if not all of it, is going into the trust. And there's only a little bit outside of that is actually a balance sheet to support the litigation and other things that might come out of it. So making sure that there are other fiduciary duties that they have to other entities, because a lot of people are directors on more than one company, or are the CEO of another business. And if they have obligations to bring the corporate opportunities or acquisition targets to those things before they bring it to the SPAC, that they understand the process that's necessary with that, and even for the sponsor themselves. And then on the sponsor side, making sure that the directors are properly incentivized. To Paul's point, a lot of people are doing this because there really is a reward, a pot of gold at the end of the rainbow, if you have equity in it, as opposed to, some of the independent directors on some of the SPAC boards getting paid like 75 grand a year flat, so that they can avoid implications of some of the perceived conflicts that the plaintiff's lawyers are talking about now from the sponsor side. But those discussions and making sure that the actual directors know what's going on, especially with first-time SPAC directors, they may not be familiar with what's going to happen in the SPAC IPO. It's a lot faster. It happens much more rapidly than a regular way IPO would. And then once you're on the board, having an understanding of what those board meetings are going to look like. You don't have an operating company. You really are there to identify, evaluate, and then acquire businesses. And that's very, very different from what most people may already have experienced.
Yeah, thanks, Travis. And that's a good segue, Paul, into kind of the target identification phase and really the responsibilities of board members versus sponsors, during that phase. I mean, do you find yourself kind of laying out a framework for the board in terms of different responsibilities? I mean, how is it that, a board member should look at their responsibilities on a SPAC board?
Well, let me just comment on something that Travis said. It's not an operating company, but it has to act like one. You file 10Ks, you file 10Qs, and they have to be formatted and they have to be timely, and your public auditor has to sign off on it. And so I think a lot of people, the market is resolving, I think, in a positive way. But there was a moment there where if you had a buddy in the MBA and a Fidelity account, that all of a sudden you were supposed to go do this thing. Well, be careful. The dog's going to catch the bus. You're going to have a successful IPO, and now you have a public company with very serious reporting requirements. And so it is a public company before it achieves its business combination, and it has to act like that. So I think that that's an important point. When you're constructing your board, you obviously have to think in terms of public company. You have to say, who's my audit chair? Who's my compensation chair? Who's my governance chair? Do they have the right degree of independence? Just like you would in any other public company board. Having said that, the target identification, and this is where having a strategy matters, because I don't know how you do target identification in a generalist SPAC, again, other than hang around the locker room at Pebble Beach or something. We had a very careful screen. We sort of had a size requirement. We had a actionability requirement. If this was a private company that would always be private, or if it was a private company on the verge of intergenerational change, it got a higher score for transactability. But we said, okay, let's segment aviation services. Let's decide which segments we want to be in. Let's decide what's our size layer, and we can come back and talk to SPAC math. But just your business combination ought to be really 3 times the size of your IPO just to get us started. And then what's the actionability? And so we would go back to our board members and say, okay, well, who knows the ownership group at XYZ Aviation MRO? And usually somebody would raise their hand. And so you would use personal relationships to get the conversation started. And then there's a lot of inbound. There's a lot of people that are calling you, that bankers that have an assignment that is nominally in your scope of interest. So that's how we did it.
Well, that's really helpful to understand that and see how you're really utilizing the strengths of each of the board members to achieve a collective goal there. I mean, I think that's really important to understand as you're kind of thinking about, you know, your participation in these types of boards. Now, Travis, I mean, right now there's hundreds of SPACs in the market that are looking for target companies. What are you seeing kind of through conversations with your clients in terms of deal flow and kind of the number of target companies that are in the funnel for potential acquisition? I mean, is that a challenge right now for SPACs and for their board members as they're assessing?
Yes, yeah, no, absolutely. There are a couple of things. One, to your point, having more than 400 SPACs out there and a lot of them looking for the same targets, in addition to having the private equity funds that are out there looking for targets, in addition to having the strategics that have access to capital right now who are looking for targets, it's a seller's market right now. And so if you're in a SPAC, you have a much easier time raising that SPAC IPO capital. And so now you're out, and some people call it a hunter's license, but in reality, like, you've got a mandate, right? And so your banker that did your IPO, who is going to receive a fee when you get the deal done, they're incentivized to help you, but you're not the only SPAC that they have taken public. So having that, I wouldn't say laser focus, but having an idea in advance of the IPO of what you're actually going to achieve and making sure that those targets are up for being acquired is important. And then having the flexibility to be able to pivot after you've talked to some of these targets is very important. And there are a couple of things about that. One is, and just a reminder to everybody, you can't be having substantive discussions with any of these targets prior to the IPO. It has to happen after the IPO. That's an SEC requirement and an IRS requirement. But once you do start talking to these companies, things will move really fast. And that's not just with you, but with another SPAC. And a lot of the companies are going through these SPAC auctions where there will be 5, 10, or 20 SPACs that are talking with them. They may have already gone through the process with private equity and not gotten a bid that they found interesting, but the SPACs are willing to offer more capital because they're taking more of a venture capitalist approach to the growth model or growth projections. So I think if you look at that 400 or so SPACs, what their timeline looks like, many of them are going to be coming due within the next 12 to 18 months. And they will be even more aggressive then than they are now, which means if you're just now getting a SPAC off the ground, most of the SPACs at this point disclose the risk factor of there is a lot of competition for deals at the moment, and it's only so. Back to Paul's question at the beginning, why are you doing this? Make sure that you've got a plan in order to distinguish yourself among that field.
Yeah, Travis, that's really helpful. And look, just adding a little bit based off of conversations I have. I mean, one of the critical points that we've had conversations on with sponsors has been kind of the prioritization over the type of target, right? Whether it's a domestic target, international target, whole enterprise, thinking about a roll-up situation, thinking about a carve out, right? And I think people have to have a certain level of competency and conviction in the type of target that they're going to go after, right? Because each of those have their risks and their benefits, and so making sure that collectively as a sponsor group and a board, you're on the same page, especially when you come back to, as kind of Paul mentioned, the industry focus and those generalist versus very specific focused SPACs. You did ultimately have a conversation with your investors in a thesis. And so making sure that you're following through that thesis all the way through the end. So I think that's incredibly important. And Paul, happy to have you kind of jump on that point and see if there's anything else that you'd add from a target identification and supply demand type of issues.
No, I think that everything that Travis said is true, that there is a bubble out there that has to flow through the system. Most of those have 18 to 24 month timeframes associated with them. The first quarter of this year was a mad rush to the IPO window. And so whatever we do next, we will be patient, because the good news is there is a ticker on that money. It doesn't stay out there forever. But for once, patience will get rewarded here, I think, as opposed to, gosh, let's rush out and do the momentum thing. But if you think about, your targets are going to come from 4 areas. One is replacing the Series C and the venture funding. Pipes are more and more important to the market. Pipes are less fond of that kind of opportunity right now. They want some more commercial maturity, that's fine. The other one will be, as we said, private companies that have a need for a public currency, intergenerational issues, growth issues, divorce, acquisition, delevering, whatever. The other is PE sellers. PE has not traditionally wanted to sell to SPACs because they are usually promoters and not promotees, and it does not represent immediate liquidity for them. That's changing to some degree. There are more and more private equity firms that are willing to exit to SPACs that they trust under certain circumstances. We had a lot of reverse inquiry from PE-owned aviation businesses, for example. And then the fourth one is the one that we're most interested in, and that is the corporate carve-outs. We've done a lot of that in Genesis Park's history, I think 11 of them. But I think the next best round of targets for people like us are, okay, I'm a big company. I have a subsidiary that, if it were freestanding, would command a higher multiple than my core industrial multiple, but they're still an important vendor to me. So, I need to give it a public security in a spin environment, but I need to do that with people that I trust, because they're still a really important vendor to me. And I'm going to liberate the multiple, but I'm not going to really liberate the operations. Those are people that are going to want to talk to us, to people that are sort of corporate grown-ups, that know how to operate businesses and know how to be good partners. So those are the 4 categories I think that targets come from. And you can tell by what I said that I'm most attracted to the latter category.
I'd echo that. And I think that one of the other important things about that last category is that that company, when it actually is public, probably is going to have the right team to continue as a public operation, because it already had a public accounting function, PCAOB audits and the like, that once you're a public company, you have to put those things in place. Series C style companies, many of them aren't ready to be public. And so they think, oh, well, a SPAC is an even faster way to become a public company, but they don't have the team built out. They don't have the internal controls built out. And they, you can get that merger agreement signed very quickly. And before you know it, you're a listed company on NYSE or NASDAQ, and you're just not ready. The other good thing about that is to Paul's point, when we were talking about who are the good sponsors, a sponsor that has something to offer more than just a balance sheet is really important. I think that a lot of the directors, it's one of the things that they'll have to offer to the SPAC. One thing to keep in mind is usually the SPAC directors are not all going to be directors of the company after it has gone public. And normally the SPAC itself doesn't have a controlling stake economically or voting in the the D-SPAC combined business. So it's going to be that minority position, maybe has one director or two. Maybe there's a carryover of an executive officer. But that also means that for the people that are listening on this call, there are going to be new directorships that are opening up, right? Particularly if there's an overlap between the original public company and the new public company. Director interlocks and things like that may prevent carrying over a significant number of directors.
Yeah, I think that's right, Travis. And then just going to some of the chat, Paul, when you're looking at a target company, how do you think about the diligence process, looking at these entities, right? So to Travis's point, there's some that are less advanced in terms of their scale and structure, that when you think about the continuum, are not ready to be public companies. I mean, what is your process in assessing the readiness of an organization? And then, from a pure diligence perspective, that you're comfortable that this is the type of entity that you'd be interested in investing in?
We do it in work streams, and some of them require, third-party vendors, obviously legal, accounting, IP, public company readiness. You don't actually have to be compliant with SOX compliance. Is that what I'm not saying it correctly? But there's a 2-year hiatus where you get to be public company compliant in terms of your internal testing and controls and such as that. I'm sure we'll talk about the ability to publish projections in an S4, which is the SPAC version of a regular way IPO S1. I don't know why S1s can't do projections and S4s can, and I think that the regulators are probably going to resolve that. But the point is, being able to publish projections is one thing, but being able to publish projections that you can achieve is another. And so we do work streams, and obviously there's site visits, there's third-party consultants. Is the industry as robust? Is there as pent-up demand as everybody says? Is this going to be a great public company? And so again, it's an all hands on deck, and it's a multi-stream consideration. And I hope that's responsive to the question.
It is. Thank you, Paul. And Travis, maybe you can touch on some of the the forecasts, conversations, and kind of the differences between an S1 and going through a proxy and having those forecasts there.
Sure, and I'll try and keep it high level for the audience because I know people get bored with some of the things. But the gist is, and this is an important point for people to remember. The SPAC is a public company that is doing a merger with another business, right? So if you keep that in your head, then you'll start having bells ring about fiduciary duties, other things like that. You're also going to have disclosure obligations, including management projections. So management and financial advisor projections are typically required to be disclosed in public M&A. That's why you've got those financial advisor decks that get posted with the merger proxy and the S4. That is what is triggering the disclosure requirement. And you get into things like, do you have the same set of projections that are being provided internally to the board, to the PIPE investors, to the target, and vice versa. But in an S1, in IPO land, normally people market their deal based on historical growth. In the MLPs and yieldcos, we actually do in the S1s use 1 year of forward-looking projections. But when you think about how those work, you know what the assets are that are going in, and you've got a very clear idea of kind of yield-based assets as opposed to growth-based assets. But there's not a strict prohibition from the SEC on forecasts in a traditional IPO. It's just, it's much more narrow. Now, one of the things that the SEC has said recently, I know that there was a question in the chat of, is there new regulatory guidance or the like that's come out? People typically in the SPAC context like to rely upon a safe harbor or forward-looking statements and assume, well, it's not an IPO and it's not a blank check company. So therefore, we get to rely on that safe harbor for forward-looking statements. That hasn't been resolved in the courts yet. But one thing I'll say is you were never permitted to lie in a registration statement. So you need to make sure that whatever projections you put in have a reasonable basis, that there's meaningful cautionary language, that these things may not come true, the risk factors associated with that, and be responsible with other people's money when you're trying to make those projections. But I think that there are two different classes of sponsors: those that understand the public company laws and are going to comply with them and are going to be reasonable in their forecasts and things like that, and then the other ones, right?
Yep. Sorry, Paul, looks like you're going to chime in.
No, I agree with all that. I just wanted to, at some point, let's talk about sponsor economics. And I see in the chat there's a question about the accounting treatment of warrants and director compensation. So we can go wherever you want to go.
So before we get there, I mean, we've been talking a lot about the role as kind of a board member on the SPAC side. What about the other side of it? So, some of the folks on the call here may be board members of private companies that could be approached by a SPAC. And so, what do you have to consider if you're a board member there? I mean, maybe Paul, you can dovetail some of the economic conversation there, because certainly the economics would be something that a board member on a private company board would be considering. But what type of dialogue have you had with other board members on your targets, and what kind of duties have they typically performed when they're on the private company board considering a SPAC?
Well, trust, because this is going to be a partnership. If you are on the private company target side, you don't get to leave anytime soon. Your lockup is probably a year, could be a little bit less than that. So whatever the press release says about the value, 2.4 billion, the market gets to revalue that immediately at closing, and will do so every day. And so you don't get to leave at 2.4 billion. You get to leave at whatever you get to leave at when your lockup expires. So when you're looking across the table, the market today is not going to let them distribute what's called a large secondary, which means cash out. It might allow you to delever the company to some degree, but by and large, the target's willingness to roll some or all of its equity, most or all of its equity, is an important fact in the market today. So the pipe validates the retail investor, the role from the seller side. Gosh, these people know the most from anybody, and they're not taking any money off the table. They're going to take the ride with me. That's alignment. So when you look at that person, they're not going to write you a check at closing. They're your partner for some period of time, even if you end up controlling the company because you roll more equity than they are bringing cash to the balance sheet. So it's relationship, integrity, trust, a similar view of the industrial logic that drives the transaction. Those things are all important.
Okay, thanks, Paul. Yeah, look, I mean, my experience has certainly been that, the best mergers have been where it's been a truly collaborative situation between the private company target and the SPAC sponsors. I think Travis mentioned it before in terms of, the interaction between the two, but I mean, it really is a potential for talent infusion, an ability to help the management team on the target side through all the experiences that SPAC sponsors have and all the connections that they have. And so certainly I think that collaborative arrangement and looking to see who you're marrying up with, because you want to have the right fit when you're thinking about it on the private company board.
I'll just add from a deal certainty perspective, I think that, and valuation perspective, there are benefits that SPACs have compared to like a traditional IPO. So remember, it's a merger, it's not build a book kind of IPO. And this is mitigated to some extent with trying to market the deal to the pipe. But you're signing a merger agreement with a price in it. You can build an earnout component into it. You can't do that in a traditional IPO. You can build in contingent value rights and other things as well. You can negotiate the promote and the warrants with the sponsor. So when you're putting that balance sheet, there's really a question of what is your pro forma capitalization going to look like after the deal is done. And that matters because you're going to have to deal with things like redemptions from the SPAC holders, the warrant overhang after it's done, and you know, sometimes people are putting, you look at this Goldman Miriam deal that just happened, there's a vesting schedule on the sponsor's promote. And those are attractive aspects of a SPAC when you start putting that all together that you may get, but not in a traditional IPO. And then going back to what we were talking about earlier, you can get valued based on a forward-looking multiple of growth projections as opposed to purely historical financial statements that are included in an S1. That can be very meaningful for a high growth business.
Thanks, Travis. Paul, anything else on the economics that you'd like to highlight? I mean, I think, you know, when I'm having conversations, it many times does come up in terms of, look, there's this promote, there's the warrants, you know, how should I be thinking about those things as I'm considering each of these deals?
Well, it's dilution, but let's do some math here, because it's a little disturbing that even some financially sophisticated observers say, gosh, well, they closed a $2 billion business combination, so the sponsor just walked off with $400 million in promote, you know, 20% of the overall deal. Oh, but that were true. God, that'd be lovely, wouldn't it? As a sponsor, it would. That is not how it works at all. You know, it is nominally 20% of the original IPO. And remember, you have the 1 times 3 thing we talked about. You know, a $200 million SPAC should probably do about a $600 million deal. The pipe itself comes in unpromoted, so it sits on top, so it dilutes the 20% also. And so when the smoke clears, you know, you're probably, and again, everybody's attacking your promote at each point in the equation. And so Travis has obviously been on both sides of this, but the IPO investors, you know, when you're doing the testing the waters calls, they will go after your promote. They'll either want it or want you to abandon it, which creates accretive effect for everybody else. Your target will go after it. Your pipe will go after it. So, you know, you have to protect your promote because it's juicy and it's sitting there, and people will try and, again, do earnouts and do contingencies and all these things. So when the smoke clears, if you're a sponsor, if you end up with 5, 6, 7% of the headline value of the deal as your sweat equity, that's about right. And people who think that this is free money, I just encourage you to go get yourself some. You know, this is real work. You know, we have been working hard and putting a lot of money out for 16, 17 months, and, you know, our deal should close in August. So it's, don't believe some of the hype on this promote, man.